So, wow, we got
Oh,
so many people
Mocha.
coming in. For anyone who doesn't know, Shiyan here is based in Singapore, and I'm in Tahoe in Northern California. So we have a very global audience right now.
I wish I could have a map, and like see where everyone is.
That would be super, super cool. Okay, well, we have quite a few people joined in, so I think we could probably get started here in a minute. Folks, for those of you who don't know us, my name is Kara. I head up marketing for Hustle Fund. We're a pre-seed venture capital firm. We invest in really early stage companies, mostly software companies, but we love to check out all sorts of businesses. And if you're interested in potentially getting funding and you have an early version of the product built, you can reach out and see if we might be a good fit for you as an investor. The webinar that you have logged into is what's really going on in an investor's brain. And Shiyan here is going to kick us off really, really soon. But before we do, I just want to draw your attention to something that you might be helpful. So at the bottom of your screen, you'll see a little box that says Q&A. So if you have a question for me or Shiyan about the content or about anything about the webinar or the company, you can go ahead and pop it in the Q&A box. And if you see a question in there that looks like something you'd be interested in hearing, then you can go ahead and upvote the questions, and we'll get to as many as we possibly can. We will be recording this webinar, and we'll share a link with it with all of you once it's done processing. So I'm going to turn it over to the expert here and put myself on mute, and I'll see you guys in a little bit.
All right, Kara, thank you so much. I'm going to share screen. And okay. So, yeah. All right. So what's really going on when you pitch a VC? Let me do a quick intro, and then we'll just hop into the slides and leave plenty of time for Q&A, because I think that's where people want to get into the meat of the issue. So a little bit about myself. I've done lots of random things over the course of my career. I have two boxes. There's sort of a mix of like operating and financing jobs. And so in terms of operating stuff, my very first job in college was writing technical documentation for a GPS navigation business. This is before the iPhone. They were doing GPS on feature phones. So your phone would like read out loud to you. And the team was all Russian and Chinese scientists. And so one of my jobs was to just read things in American accented English to train the model. And then to write technical documentation, because they were generating tons of code, but nobody had documented any of it. So that was my first internship. But probably more relevant to folks is I spent 6 years before joining Hustle Fund growing a fintech company in San Francisco called NerdWallet, which is a financial services marketplace. We took that business from 0 to 150 million in revenue over the course of my 6 years there. I think the interesting thing about it is we bootstrapped that business to 50 million in revenue. And so that's pretty unusual in the Valley. In early days, we would try to hire people, and they would say stuff like, "Who are your investors?" And we would say, "We don't have any, we have customers." And that was very confusing to people in the Valley. And then on the investing side, obviously writing pre-seed checks here at Hustle Fund with my partners, Eric and Elizabeth, but have sort of been across the range of financial services. I worked at Bridgewater. You guys might know Ray Dalio. He has lots of thoughts about the global macroeconomy and credit cycles. I did late stage venture investing with institutional venture partners in Menlo Park. And we can chat a little bit more about how late stage differs from early stage investing. I worked with Kai-Fu Lee's fund in China with Sinovation Ventures, and so have a little peek into the Chinese venture investing ecosystem, and started my career at JP Morgan covering tech and healthcare companies. So done lots of things kind of all over the spectrum of finance, but super excited to share with you a little bit about, like what is going on inside this VC's head. So I think first of all, it's useful, like when we think about ourselves as like product people, right? We think about ourselves like, who's the customer here, right? And so when you're pitching, it's like, who is this VC? What are they optimizing for? And, what does their day-to-day look like? And it's funny to think about it, but I always tell entrepreneurs, I'd never raised a venture fund before Hustle Fund. And raising a venture fund actually gives me a ton of empathy for entrepreneurs raising money, because VCs also have to pitch investors in order to raise their fund. And so when you think about what VCs are optimizing for, it's a little bit what they've said they are going to deliver to their investors. And so here, if you think about what investors could do, investors could invest in a whole range of asset classes. They could invest in the S&P 500, they could invest in emerging market things. And here are sort of the annual returns of these different asset classes over the last 15 years. And so you can see, I have a choice to invest in the S&P 500 at a 9% annual return over the last 15 years. That's pretty good, and is a very liquid thing to invest in. So why would I choose to invest in venture capital? Venture capital is a very odd asset class. It's a 10-year fund. That means that your investors' money is locked up for 10 years. And because of that illiquidity and the risk that they're taking, those limited partners want a higher rate of return than what they could get on the liquid stock markets. So let's, say assume 12% annual rate of return. What that means is that you need to convince your investor that you're pitching that there's a big enough potential business to be built here that you can deliver the level of returns that investor needs to return to their own investors. And I think what is useful to note here is that there are a lot of great businesses that don't need venture money to succeed, because they don't necessarily have those return characteristics. And that doesn't mean it isn't a great business. It just means that it might not be a venture backable business. And so I think that's a question you have to ask yourself when you go out to pitch for venture capital money. What are that person's return expectations? And does that really match up with the type of business that I intend to build? And so just, for fun, if you think about it, a 12% return over a 10-year fund, that means that, a VC is telling their LPs that they can triple their money over the course of that 10 years. And so that sort of framing in the back of your head can help you think about, like when people say, oh, you have to be 10x better, or you have to return 30 times their money or 100 times their money, like where does that come from? That number doesn't come from thin air. It really comes from backing out what a VC has to deliver back to their own investors. So just wanted to, put that out there.
And Shiyan, when you say LPs, can you clarify what that means?
Yeah, an LP is a limited partner who is an investor in a VC fund. So LPs are a huge range of people. They can be university endowments, they can be pension funds, they can be family offices, they can be high net worth individuals. And so those are all people who invest in venture capital funds because they want to get exposure to early stage technology, but they don't necessarily want to run a VC fund themselves. And so they give money to VCs to invest on their behalf. And they expect a certain level of return to come back by locking up their money for 10 years. And so, the same way that entrepreneurs, have their investors, VCs have their own investors as well. And so they kind of have to answer to them. So, all right. So when you think about going into a pitch, I think there's sort of like two things. One is like, you want to vanquish the easy no's and you want to make me believe. And I can tell you there are a ton of easy no's, because if you think about venture, here at Hustle Fund, we probably look at, several hundred pitches a month. And the majority of those things will be no's. So from a probability perspective, no is generally the right answer. And so you want to make sure you get ahead of an investor's easy no's. And once you've cleared that hurdle, you also want to make them believe. And so there's sort of table stakes hygiene about clearing the easy no's. And then there is like storytelling and vision around making me believe. I made a very silly chart, but this is sort of, like you have your thoughts during your pitch. As someone is talking, you have sort of a internal calibration in your head around, are there quick and easy ways to pass? And the reason I put out this chart is because you might think that an investor, is going to spend like a ton of time trying to figure out whether what you say is true or not and doing deep research on your market. But in a first meeting, that's not actually what's happening. In a first meeting, part of the decision is, do I want to spend more time on this? And if there are a bunch of easy no's, then the answer is no, I don't want to spend more time on this. I want to go spend time on things where I actually think, hey, I want to dig in and there's a chance to have a big outcome, a big investment. And so, an easy exercise you could do when you're practicing your pitch is to just pitch your friends and family and have them, have two columns and say, hey, like, here are like easy objections that came into my head as you were talking, or, oh yeah, these are things that make me really believe like you have a shot at this. And so we'll go into this in some detail, but at a high level, you want to think of these as like pretty rational processes, and it is. But for VCs, it's a probability game, which is, if the probability is that this probably won't work out, they're not going to spend the extra time to figure out ways that it can work out. It's your job as the entrepreneur to explain to them why, all the other things that haven't worked out, why yours is the thing that's going to work out. And so trying to get into someone's head a little bit is useful for that.
And Shiyan,
So what are the easy notes? Yes.
really quick question. For people who don't have a big network of people who are entrepreneurs, if they don't have a lot of family members who have started businesses or friends who are founders, what would you recommend for those people? Do you still think that friends and family are a good audience to practice on, or is there another resource you'd recommend?
That's a great question. I don't necessarily think that your friends or family have to be investors in order to practice on them. I think, most people are consumers of things, and so if you're pitching something that, where someone is a natural end consumer, and you can sort of at least get the feel for it, you can just walk them through a checklist that we'll kind of go through. But other entrepreneurs are also great resources for you, so it doesn't have to be, friends or family, and they don't have to directly be in your space, because when you think about business, a lot of the laws of business apply regardless of the industry you're in. And so we can talk through a little bit about that. But let's talk about some of the easy no's, and I think you'll get a little bit of the flavor of, like, if some other entrepreneur said, hey, Kara, will you listen to my pitch? Kara might look at this list and say, like, oh, yes, no, yes, no, yes, no. So when I think about businesses, and we think about laws of businesses, I always use this quote with my portfolio companies. I use it with businesses all the time, which is like, what is a great business? A great business is something that like delights the customer, right? So I'm like solving like a real need, in hard to copy, so it's defensible. I'm building something that's defensible. Not anybody can just like look at me and just do the exact same thing. Margin enhancing ways, which means my business needs to make money. And that's important to have all these three components, because if I delight the customer, but I'm giving away my product for free, I'm not going to be in business very long, right? So it's not margin enhancing, right? If I delight my customer, but it's super easy to copy, same thing. Eventually I have no margins and I have no business. And maybe initially I have great margins, but my customers aren't particularly happy. They'll churn. It'll cost me a lot of money to go acquire them. And so I try to think about those three things, like, when I talk to businesses. And I think when people hear this, they're like, oh, that makes sense to me. And so I just share that as something that might be useful to you to think about, like, who is my customer? What is the need I'm solving for them? What's the thing that's really hard here that other people can't copy? And, does my business model make sense? So the thing to remember about the checklist, that it's a probability game. So it's not a decision tree. So it's not like, oh, if it's no for one of these things, you're always out. It's sort of the sum of all these things together. You're trying to do a probability assessment in your head. Do I think these people are going to make it? Right? Do they have a reasonable shot at making it? Because most startups don't become billion-dollar businesses. Some percentage of startups will fail. That's normal. Some percentage will be like, okay, small businesses, but they're not going to knock it out of the park. And knocking out of the park is important, because when you think about what those VCs are optimizing for, they're looking for these high growth businesses. And so I think the very first place to start is like, is this market big enough? So sometimes people come and they're like, I had this terrible problem, I went to solve it, and now I have a solution. And you're like, okay, that's great, but how many other people have this problem? And how do we know, right? It might be a great solution, but if only 5 people have this problem, this market isn't big enough. And so thinking about what the market for your product is super important, because it goes back to outcomes. If your market is only a couple $100 million, you're not going to build a $1 billion business. So I think this is the, just sort of right off the bat. The second thing was like, is this the right team to navigate the known modes of failure? And I talk about known modes of failure because it's back to a probability game, right? So it's like, why do I think this team is going to succeed in this industry with this product? And I don't particularly care as much about pedigree or like where people went to school. I do care more about, hey, like, have they ever dealt with this type of customer before? Have they ever had to encounter this sales cycle or use this go-to-market strategy? Do they have a deep understanding of, what is going on here? So like, I think one flavor of things that's like harder for VCs to get behind is there's a team that has no experience in the industry and is trying to do something. And that's hard because you'll be like, well, they're smart and they could figure it out, but they might also just run out of money before they figure it out. So that's like one mode of like where things are hard on teams. The other types of teams that I think are hard is like, you have a really strong business founder, but you don't have a technical co-founder, and you're relying on some sort of outsourced shop to build something. And that might be okay in the initial stages, but then increasingly, like, how are you going to build and ship quickly without a technical co-founder? Are you going to keep paying sort of an outsourced dev shop to do your work? And so it's not that you would never invest, but it's that you have to ask yourself the question, what's the likelihood that they're going to end up in a place where they don't have a very strong technical co-founder, their product shipping is really slow, and they kind of die or they plateau. And the flip side is also true. You might have a really strong technical founder who has an amazing breakthrough, but he or she has no experience or interest in selling. Then it's like, well, great product, but how do we find customers and generate revenue? So I think the team thing is super important, particularly in the early stages. And then, another one is thinking about this customer. Who is this customer? And I think sometimes people say super broad things. They're like, any woman under 50 is my customer. And you're like, okay, but how are you going to reach them? How are you going to target them? Why would they buy your product? And I think it's okay to be like, hey, we don't know exactly who our customer is, but we think based on our early customer interviews and our initial, most engaged users, it's this kind of person. It is, it's a remote worker. It's someone who uses at least 2 or 3 different SaaS products to facilitate their remote work. And, they need to work for a company with at least 50 employees. Because then it sort of says, okay, I have a good picture of who my initial set of customers is. And that means it's easier for me to target them in a way that isn't just sort of like spraying money all over the place. And it makes it easier for me to develop a product and features that really nails this use case. And so understanding who your customer is, I think, is super important. And then what are the economics around acquiring them? How am I going to find these people? And, in our hypothetical remote worker sense, maybe it's that, I'm part of these remote work communities. I've already found my initial 10 customers here. And, I think I have access to another 5,000 or whatever it is. And so it doesn't cost me much other than, being a participant in these communities, getting this going, blah, blah, blah. How long is the sales cycle? Oh, well, all I need to do is a 15-minute call with them and I'm able to convert this person into a paying customer. Or, oh, my customer is a government and I actually have to go through an annual budget cycle and it takes me a year, right? So sales cycle is really important too, because it's a question of, can you live long enough to actually make it through the sales cycle, right? So what's the probability of that happening?
So Shiyan?
Yes.
Just to clarify, if a startup has a really long sales cycle, does that automatically disqualify them from fundraising?
It doesn't automatically disqualify them, but I think you need to have a good answer as to how you're going to be successful in the long sales cycle, right? Because by definition, you have to keep the team alive for longer before you can even see whether your thesis plays out. And so then the question is, why should the investor believe that you have a better shot at surviving than other people?
And what's a good answer for that? Or are we going to get to that later?
What's a good answer for a long sales cycle? I think there are some people who their founders already come from those industries that have long sales cycles, so they have pre-existing relationships with those buyers. So I always sort of make this joke, which is I hate selling to HR. Lots of people love to pitch, HR software solutions because I think everyone has been the victim of a bad HR department at some point in their career, right? And so they're like, oh my God, this is a terrible problem. I'm gonna go fix it. And then, but the problem for me is always like the buyer is like an HR person. And in general, like HR people are not huge, like early adopters of technology, right? So it's like really hard to convince them that they need to do this thing. And, you know, often companies think of HR as a cost center rather than a revenue generator. And so like when they're like doing their annual budgets and they're like handing out budgets, no one's like, oh, why don't I give HR more budget, right? So it's like a hard person to sell to. And so in general, I don't really love selling to HR. And so in general, I don't fund a lot of things that are HR software related as a result of that. But, you know, there are people who are like, hey, I used to sell HR software in the past, or I am an HR professional. I know all of these people already, and I understand how they think and their procurement processes. And oh, by the way, here's how I got my first 5 customers. So I wouldn't say that like a long sales cycle is a definite like deal breaker, but I would say you need to have a plan to figure out how you're going to last that long. And I think for you as an entrepreneur, you want to know that answer too. And so thinking about how you're going to attack that, I think is important.
Thank you.
Awesome. So number 4, it's something that like maybe it's a little odd, but I always try to ask people like, how does this product or service make people feel? How does it make your customer feel? And this is a little bit of trying to get to the question around like, what is the job, you know, that this product or service is doing in this customer's life? Is it making them more money? Is it saving them costs? Is it making their lives more convenient? Is it preventing them from a lawsuit? You know, like, how does it make you feel? And I'm always trying to dig into, does an entrepreneur have really good, unique insight about their customers and their problems? And that's related to 5, which is, what is the unique thing that you're doing that's defensible in this business? Like, I don't actually believe that there are that many businesses where it's like you have a unique, you're the only person attacking the problem. Like if it's a big problem, there's lots of people attacking it, but everyone has a different way to think about attacking it. And so I think being able to articulate why you're different from your competitors and why your insight is going to help you win is really important. Sometimes people say like, oh, well, we work really hard. And it's like, well, I'm pretty sure your competitors are working really hard too. Like that's not actually defensible or unique. And so trying to think about like, how do I think about this world differently than other people? And how does that shape the way that I do my go-to-market, or how does that shape the way that my product shows up? And why does this ultimately help me win? I think is a really important thing to think about. And then the last thing around the easy no's is like, why now? Like, why is now the right time for this business to exist in the world? Has there been a platform shift? Is there some new technological capability that's allowing a business to exist where it didn't before that you're kind of going to ride the wave of? What is it that makes like now the right time for this business? So these are just sort of like, it's almost sort of second nature now. When somebody pitches me something, these are sort of the thoughts that are like flooding through my head as, you know, I'm listening to someone tell their story. And then I think the flip side of all this, you know, is to like make me believe. And this is part of the, hey, okay, you know, this sounds like a reasonable thing, but why this team? Why this company, right? Like, why should I write a check here? You know, make me believe. And, you know, what are ways to help people believe? And I think a little bit of, sometimes people pitch at a very micro level. They pitch very tactically about their business. But part of making people believe is to take a step back and to say, like, how is the world changing, right? And why is my business a part of this change or driving this change? And how do I get the investor to agree with me that this is the way the world is headed? And, you know, you do want to, you know, be part of this change and ride that wave. And that's why this business is like integral to that. So I think this is sort of the thing which is like people often miss out on, is this sort of bigger macro piece on like, how is the world changing? And related to how is the world changing is this timing thing, right? Like the world is changing in this way. Here's the data points that help you understand why the world is changing this way. And my business is part of this. And because the world is changing in this way, this is the right time for this business. And because it's the right time, you know, this is also the right team for it. And And then the last thing is to, get the investor to dream alongside you, which is this idea of like, what are all the ways in which we can succeed? So back to the probability framing, if there's only one way to succeed in this business, probability of success is very low. If there are multiple ways to succeed and you can get the investor excited about all the different ways there are to succeed, then you can get super excited about it. So the example I give is way back at IVP, we were investors in Twitter, early investors in Twitter. And at the time, Twitter was doing zero revenue, but the usage was growing, great user growth. And people are always like, why would you do that investment? And this was a long time ago. And at that time, Twitter, I think the sort of popular press was carrying Twitter like, oh, this is some stupid thing Silicon Valley is doing where they talk about what they ate for lunch. And so, when we did the deal, like, I think half of my friends were like, this is the stupidest thing I've ever heard. And then half of my friends were like, oh, that's so clever. Like, how did you get into the deal, right? And so it's interesting to think about like why people sort of respond that way. And what you saw on Twitter at the time was that was a time when they were the only one doing the one-to-many type of relationship model. So like Facebook at that time was still the double opt-in, very much the friend thing. Kara, I say I'm Kara's friend. Kara has to say that, yes, Shiyan is my friend before we can talk to each other. Whereas Twitter was sort of like anybody could follow anybody and you didn't need any approval. And so it became sort of this like broadcast mechanism where people could like say stuff to lots of people. And that was part of what was driving the growth. But then the second thing that you saw was that like people weren't really necessarily tweeting about their lunch, although there was some random useless tweeting. A lot of times people were tweeting that they had links in their tweets. They were driving traffic to different places. And you were also seeing like brands use their Twitter handles not just to develop followings, but also sometimes to sell things. Like Dell Outlet had a handle and they sold a bunch of refurbished computers, on their Dell Outlet handle. And so when you saw that, even though the business had zero revenue, you could imagine all the different ways they could succeed, right? You could imagine, oh, well, I could charge people for tweet placement, right? I could charge people for, commerce features. I could charge people, like, there's all these ways you could imagine them succeeding based on sort of the audience that they were growing. And that gives you confidence to make an investment, even though you're like, this just seems like a bunch of people tweeting random things. And so I think getting investors excited, but also, for yourself, thinking about, hey, there isn't only one path to success. There are actually multiple ways that we could succeed. And we're going to start figuring those things out along the way. Can be really useful to part of this sort of like make me believe aspect of a pitch.
So one quick clarifying question there, because that last part makes a lot of sense to me. But I'm curious, are you as an investor looking for a startup founder in their pitch to tell you all the different ways that they plan on making money or features that they plan on adding? Or are you looking for something a little different?
That's a great question. I think you want, I would say, sort of like near-term clarity, like long-term big picture. So I like it when people have near-term clarity on like, hey, in the next 12 months, here are the things that we know we want to go do. And this makes sense in the context of our longer-term plan where we could do A or B or C. Right now we're on the path to do A, but B or C are also things that might happen. So it's not like, hey, give me like a minutely detailed roadmap for, the next 10 years, because I think that's impossible and not a good use of time. But I think it's starting to paint the picture of, what are the different ways in which this thing could go. And we can sort of talk about, the nuances of that, because I think there's different flavors of it where everyone eventually is like, and then we have a digital wallet. And you're like, I don't understand, you're a software, but like, it's not connected to anything, right? So I think it has to be in the realms of plausibility, but, you're just trying to think about, it just goes back to like, what's the core asset I'm building? So in this Twitter example, my core asset is like my audience and my engagement, right? And then based on this core asset, what are the different sort of like lines of businesses I think could sprout off of it? Here are the low-hanging fruit, highest probability things we're doing right now. But I could imagine that in the future, these things could be possible. So the next part, I just made up some companies And I thought we would just practice on them because I thought it'd just be useful to have something like more tangible to sort of use the framework of like easy knows and make me believe. And this shouldn't. There may be real companies that look like this, but this is all fictional, right? So this is all a fictional sort of exercise. Okay, so our first fictional business, an immersive AR-driven dining experience, right? So like, I bet you guys can come up with easy knows right now in your head, right? You just like jot them down. You just and I don't even need to hear a pitch, right? I could come up with like 15 easy knows right now. And so, first of all, it's like immersive dining experience. You're like, what is this? Is this even a big market? Like, who are these customers? How scalable is this? Margins in food and beverage are super low. There's all this operational complexity. Like, so when I think about this, like easy no list, like if I were pitching this business, like I would want to address those things proactively in the course of my pitch. And, if you flip it to like reasons to believe, like if I had to pitch it not knowing anything about this business, I would be like, well, there's a real macro shift to an experience economy. Things like the Museum of Ice Cream, Meow Wolf raised, $40 million. Like, it's time to build a new Disney, right? Like, what would a Disney look like in an age of like VR and AR? And hey, the scalability thing. Actually, because of our VR creation technology, we have scalable experiences across geographies. Oh, by the way, we've already done an MVP. And in the MVP, here's what the cost structure looked like. And oh, lots of people want to work with us. We have partnerships with these people, and they're going to subsidize our content and distribution. And by the way, like I have someone who's ex Pixar, I have someone who's ex, Universal Studios, and whatever the case may be. So I think, if you don't sort of preempt some of the questions that are on the easy no column, when you pitch, you basically just go into a hole where the whole time in the investor's head, you're just like, this is going to be really hard. It's going to be really expensive, and I'm not really sure these people even know how hard this thing is going to be. Versus like, oh, yeah, this is really hard, but it is time, to have a new type of business like this. And gosh, maybe these people are the right people to do it, right? And so I think that's the sort of challenge of pitching that you always kind of want to be in the reasons to believe column, right? And then get rid of those no's. All right, next one. Marketplace for service providers to start up. Okay, this can be any marketplace. It doesn't matter what it is. Can you imagine sort of what the no's might be? Startups don't have any money to spend. Like, why would we target them as customers? I think the customer acquisition is really challenging and expensive. It's really easily disintermediated. Like, once someone found a service provider, why would they go back to you? I already found a lawyer. Okay, now I'm going to just deal with the lawyer directly. I don't have to pay a platform fee. And, reasons to believe. Hey, small businesses are the backbone of the American economy. 90% of people are employed by small businesses. And small businesses are easier and easier to build due to technology. There are huge businesses, Shopify, Square, Fair, they've all leveraged technology to reach previously, underserved small businesses. So, I think the thing to think about, and the marketplace one is something I'll call out because a lot of people do end up pitching marketplace startups, is marketplaces are incredibly hard to build. There are many examples of great marketplaces. There are also many carcasses of dead marketplaces, right? And so spending a little bit of time studying like modes of failure, modes of success, and weaving those things into your pitch to show that you understand that, I think can go a long way. But, honestly, we do see like a lot of pitches where, people just get stuck in the easy no column because they just don't address those things at all. Okay, and our last one, and we'll get to Q&A because I know that's what people actually want. An enterprise solution for companies to better measure and track their carbon footprint. And this is sort of like enterprise more broadly, right? This is just very specific, but okay, well, sounds great, but I don't know how many businesses are clamoring for a solution to track their carbon footprints. It's not connected to my P&L. Maybe there are some companies who care, but those are early adopters and they're a pretty small segment. And once again, as I hate selling to HR, right? So this is like one of those things where it's like, yet another thing. Reasons to believe, right? Like, could you reframe this, right? Hey, this isn't just about the environment. This is actually about talent and hiring, because millennials really care about this, and this actually changes which companies they would work for. And so companies would do this not because they're trying to save money or like pretend to be good, but because they actually want to hire the best talent, right? So I think there's a lot of things to think about. It's still a very long sales cycle, all that sort of stuff, but helping people understand like what is the angle that you're going in with and like why that's gonna succeed, I think is super important. Okay, so pretty easy takeaway, like vanquish the easy no's and make me believe. And so Kara, maybe we'll open up to questions and I'll let you facilitate that.
That sounds awesome. We had a question actually on chat that I tried to get over to Q&A, but I thought it was such a good one. I want to bring it up now, which is when a startup first gets on a phone or a video call with an investor, what is a good way for them to introduce their company quickly, especially if they're in an industry that might have a lot of easy no's, to like quickly grab your attention without dragging the investor through like all sorts of, inspirational monologues that last 5 or 10 minutes.
I would just get straight to like, what's the customer and what's the problem they're facing, right? Which is like, hey, I'm Shiyan. I'm building X, right? A solution for Y customer that does Z. Like I would just kind of get straight to the point about like what exactly I'm doing. And then I would talk about like how far along I am, which is sometimes it's really hard to tell whether people like have done something or haven't done something. It's like, is this live? And they kind of like keep talking, and then finally they're like, and we have 1,000 customers. You're like, oh, we should have said that up front.
Mm-hmm.
So I think it's like, hey, great to meet you. I'm X. We're building this thing for these people with this problem. We have 1,000 customers, and they're doing on average, average basket size of X, or they're paying on average a monthly subscription fee of Y. And here's where we think we're going to take it in the next 12 months. So that's like 30 seconds, and it gives you a really fast snapshot of like what's going on, and then you can like get into the, okay, here's the market, here's the problem, blah 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 blah.
Cool, that's helpful. Thanks. Sarah had a question about marketplaces. We actually have a lot of people tuning in that are working on marketplaces, so this one seems particularly relevant. What do you think are the most common factors leading to marketplace failure?
Oh gosh. I mean, the challenging thing about marketplaces is basically you have two sets of customers, right? And so like you have both the supply side and the demand side. And so it's always a question of like, which one do you build up first and how do you get that market to clear, right? Because if you don't have enough density, the market doesn't clear well. And so I think the most common, I think, is people tend to go a little bit too broad right out of the gate. And so then it's like really hard for them to build up density in any one thing. And so I would say like, if you're going to build up a marketplace, maybe you want to be the marketplace of like everything, but maybe you just want to start with plumbers, because then at least you can build up your understanding of like, okay, here's how I acquire plumbers, here's how I acquire plumbing customers, and here's how they're transacting on my marketplace. And you can kind of get all your ducks in a row with one sort of more narrow focused thing rather than trying to go broad right out of the gate. And I think this is true of most businesses, not even just marketplaces, where it goes back to like, what's our definition of our customer? Oh, it's like anyone who needs any service provider ever. And it's like, well, that's really hard, right? Because then it's like, how do you spend your time? Like, who do you acquire, right? Because you acquire like someone who wants carpentry services and you just don't have any carpenters on your website yet. So that's like really hard to deal with. And so I think with marketplaces, I think one, that's sort of like just managing the supply and demand. I think the second thing to think about is like, why should someone use your marketplace over what they're already using? And I think the argument people always make is like, oh, it's like really fragmented and like discovery is really hard. And you're like, yeah, okay, but then why do they come back, right? Like, is it so much easier for me to transact? Are there guarantees around quality and service, that I couldn't get elsewhere? Is that fee like really worth it to me? And so I think when you look at like marketplace failures in general, it's like disintermediation, right? Because people are like, well, I found it once, I'm just going to go direct, I don't need to pay you. It's like poor quality control, because they try to do everything, everyone had a bad experience, and then it's like really expensive for you to go like reacquire that customer. And so you have to really think about like what's the value you're delivering in the marketplace, like why does this make sense as a marketplace versus something else.
Cool.
And I think sometimes people want to make these like very lightweight marketplaces where they're like, oh, it's just a place where people, but then the trade-off of being super lightweight is you don't have any value, right? So how do you get deeper into the value stack?
Okay. Well, we can dive into that if we have time, but we got so many questions. I want to get through more, but thank you for that, Shiyan. So one person's also asking about how do you specifically think about startups pursuing growth at the expense of profitability?
So I guess that's like an interesting question, which is people sometimes frame those as like opposite ends of the spectrum, but I'm not sure they totally are. So let me explain a little bit, which is the only reason you're like growing is because you believe that the people that you're acquiring as customers are going to be profitable customers for you over time. And then the question is, well, what does over time mean? And how long is that time? And how do I know? And so I think sometimes people say, well, I'll be profitable later, but they don't actually have a great sense of how they will be profitable later or when later is. And so sometimes I think you need to have the discipline of like saying, I know this person is going to be profitable in 5 months. Like I spend money on this person up front and I know they're going to be profitable in 5 months, and this is how I know it. And so as long as this equation holds, I'm going to keep putting money into it, and that's okay because that all sort of pays off in the end. But I think the ones where it's more challenging, it's like I'm giving this thing away for free. They're going to be so engaged, and then I'm going to charge them for it, and that's when I'm going to be profitable. And I don't think that's actually a real trade-off, because you don't actually know that the person values the thing enough to pay for it because you gave it away for free. And so you don't have great sense of like when that stuff is going to come around. And I have a much harder time with that. I think this also shows up in other places, right? Where the basket sizes are really small and you're like, okay, well, I acquired this person. If only I can get them to transact with me 5 times, they'll be break even. But all you've proven so far is that they'll transact with you once. So is it profitable? Is it good growth to say I'm going to acquire more of these people when I've only proven that they can transact with me once, but I actually need them to transact with me 5 times to be profitable or break even? I think that's like a really hard argument to make. And profitability, I think, it feels very hard. Like you're like, I don't want to ask people to pay me, but if you're really creating value, someone's going to pay you, right? Because you're solving a problem that's painful enough for them that they want to pay you for it. And like digging into like when that happens, I think is useful. I think the one that's like people often think about it's like SaaS, where people spend a lot on SaaS sales and marketing because once they get them, the churn is really low and people are sticky, and you can do sort of account expansion and things like that. I think that's a little bit of a different case, but it's still the same thing in which like I think you'd want to have confidence that you knew, okay, for every dollar spend that I have in a customer, I can acquire how much revenue over what period of time. And that's a little bit hard to tell in the beginning, right? Because if it's an annual product, you don't even know what your annual churn rate is until 12 months later. And so how do you have confidence in those things? And I think the last thing I'll say on that is that profitability can fuel growth, right? So profitability gives you options for growth later on. If your growth is only fueled by investor capital, it can put you in a situation where you don't have a ton of options if you can't actually turn those customers into revenue.
Mm-hmm. Okay, thank you for that. Okay, someone asked a kind of an interesting question. So obviously, there's a lot of easy no's. It seems like for just about every pitch you hear, you could probably come up with a lot of easy no's. That's my biggest takeaway. Um,
Totally.
but there's a lot of companies out there that have raised gobs of money that seem like they have the most easy no's. One example is a company that does. It's called like Liquid Death, I think, and it's they make canned water cool, and they've raised like $9 million. So obviously, I don't know if you yourself have invested in that, but do you have any sense of like why a company like that might have been successful in raising, given that it's, I'm like, don't quote me, but kind of a ridiculous company with a lot of easy no's? I hope no one from that company is on here.
Yeah, I mean, I think that's a great question. There's a lot of things where you're like, what? Um, and I think that's the challenge of venture capital, right? Which is that uh, on a probability weighted basis, a canned water company is probably not a great investment. However, for the investors of that business, they saw something that was working in their business sufficiently to say, even despite those things, I think there's something different here. And so, I mean, you could do the exercise. Like, what would make an investor invest in something like that? You know, uh, maybe the founders are incredible brand geniuses, and people are tattooing Liquid Death, logos on their skin, and they are, we have data that they're choosing Liquid Death on a 2-to-1 ratio to all other, packaged water companies, right? So we don't. I haven't seen the pitch. Okay, so I don't know. I'm totally making stuff up, but I think that actually is true. So you know the funny thing about venture capital is, like, if you look at everything that went out, right, all the IPOs in the last 20 years in tech, okay, or all the unicorns that you can think of, they were all passed on by dozens of early stage investors, because at the stage that they were at, there was an easy no. And then some percentage of people saw something different, and they were like, oh, I think something else is going on there. I'm willing to put some money in to see if that plays out. And so I think the flip side of like the easy no's and then the make me believe is, you actually need to talk to a lot of investors, because everyone has like a slightly different setting on them. A lot of early stage investing, there is an element of like taste and experience to it. And you could you will put the same deal in front of 10 investors, and half of them like, this is awesome, and half of them like, this is terrible. Um, and maybe for the same things. So what I would say is that, like, people will weight the easy no's in different percentages. So, some people are really into, the technical parts. Some people are really into go to market. Some people are really into like market size and demonstrable, types of things. So everyone has roughly the same checklist, but everyone weights their checklist in different ways. And so that's how I would think about that.
Okay, that actually that's a great lead into the next question, which is how do you get to know an investor before you talk to them so that you can better understand what their checklist is? Do you think there's like a secret sauce for that?
No secret sauce. I mean, I think I would look at their portfolio, what they've invested in the past. I would look at their writing, what they've written about various industries or companies. I would look at, their tweets, to the extent that they tweet. But I think if you look at an investor's portfolio, you can start to get a feel for what are the types of businesses they're interested in, and kind of where their biases lie. Because we all have biases, right? We all have things that we love or we hate that are a function of basically our experience with those industries before.
Okay, that's fair. There's a couple questions in here about VCs that will tell a startup founder that they would be interested in getting updates from them for the next 3 months, but that they would like to see more go-to-market strategy or more product market fit or a little more traction before moving forward. And the question here is, do they really want the updates, or is that just a way for them to pass without being jerks?
It's a great question. So if you think about sort of investing, it's about like patterns over time. And a pitch often is just one point in time. And so when someone's like, hey, I'd love to get updates, is they want to just add more dots in their pattern and to say like, hey, this is like actually tracking in a really good way, or yeah, my initial assessment was like, and it continues to be, and so I think I would encourage people to actually keep your investors posted, because when you can demonstrate a track record of saying, here's what we're going to do, and hey, by the way, we did it, that is a really good fact pattern for people to come and participate in the next round that you might have. And so, you could imagine that maybe like when you're going out to raise your first round of capital, you might meet with like 50 people, right? But eventually maybe like 2 or 3 people invest. But there's still, 48 people who you've already sort of told the story to, that were interested enough to take that first meeting, and that you want to keep on the list and say like, okay, like every couple months I'm going to send out like an update on like the business and what we're doing, to keep people like excited and engaged, so that by the time I go out and raise my next round, I actually have a backlog of people who've seen the story progress, and have now more data than like sort of starting with a new set of investors. And so, yeah, I think it is, if people do say like, keep me on the list, you should definitely keep them on the list. And obviously don't disclose things that you wouldn't want your competitors to see. But to the extent that you can continue building a fact pattern with investors to say like, hey, I said I was going to do X, and hey, look, I actually did it. I delivered the thing that I said I was going to do. That gives people more confidence over time, right? It's like when you think about it, like, why do investors invest in people they know? It's because they have a longer fact pattern with those people, right? Like, oh, I worked with this person, I've seen them execute these projects, and there's someone who's like incredibly creative or whatever the thing is. But that's really hard to tell in a single pitch, right? Because you just have this like one sort of 1 hour artificial construct of a meeting to make an assessment. And so giving people more data points is useful.
Okay, cool. That's helpful. Someone named Jim, actually, he emailed me in advance with this question, so I want to make sure we get to it. Hi, Jim. So Jim's asking, for a company that has a technical product, software, I would imagine, but any technical product, what's the best way of demonstrating like differentiation in that product versus competition without getting super technical?
I think it's okay to be technical about the differences, right? But I think I would just try to connect it to like, why does it matter for customers, right? Because the diligence there would be, I would just call a customer and who has bought, your product or a competitor's product, and I would be like, hey, Kara, I heard that you're in the market for XYZ tool. How did you think about your buying experience? And I would try to understand whether or not all those technical differences actually mattered to the buyer. And so I think it's okay to be technical, but I think you want to be technical in a way that is like connected to like, why does this matter to the people I'm trying to sell it to, rather than, why is it technical for technicality's sake? And so I think sometimes technologists get super excited about the thing they're building, but they don't necessarily connect it back to the customer. And so I would love to always just be able to say like, okay, this is a technical breakthrough, but who cares about it? And is it actually going to change someone's buying decision over what time period?
Okay, that's helpful. There's a lot of questions in here about traction. In your opinion, what's a good indicator of good traction?
This is really going to vary by investor, because depending on their stage, they're going to have very different ideas of what traction looks like. And so I would say that like, for a seed stage, so we're pre-seed, right? So for us, I don't think we need to see a ton of traction. We like to see customer development and some initial customers, but you don't need to be doing like tons and tons of revenue. In the seed stage, I would say most people will probably want to see like 500K revenue. In the Series A, like 1 to 2 million in revenue. And I think the way to think about traction is like, how much of this model have you de-risked? right? Because if someone's like, well, I have 500K of revenue, and then you look at it and you're like, oh, but that's services revenue. That's not actually product revenue, and you're trying to sell me a product business, then that's not actually de-risked, right? Because you still haven't demonstrated to me that you can sell this product. And so I would think about traction first by the stage that you're pitching that investor for, and then in the context of like the de-risking of it, which is like, does anybody want it? Okay, so that's like one customer. I've shown that one customer wants it, right? And then it's like, do enough people want it? It's like, okay, I have like 10, 50, 100 customers who look similar and have the same problem, right? And then the next one is like, do I have a repeatable, scalable sales motion? Okay, I know how to go reach that next set of customers because, hey, here's what my funnel looks like. Here's what my pipeline looks like. And, boom, 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 boom. Here's what's going through. I think that's the way that I normally think about traction. Is what are the elements that I've de-risked along the way?
Okay, cool. That's helpful. Well, I know we're almost at time, but I think we have time for one, maybe two more questions. Crystal has a question about creating FOMO. So a lot of startup founders hear about creating FOMO with their investors to get the investors to move a little faster. For you, what creates FOMO? And then also, how often do you want to hear from a founder once you're really thinking about the opportunity? Is it annoying, or does it continue to create more FOMO if they give you updates? And FOMO is fear of missing out, for anyone who doesn't know.
Yeah, I mean, I think as a founder, the best FOMO creation is to run a good process, right? Where you like meet all of your investors within a like reasonably constrained period of time. You're getting to decisions, things like that. And it's because, like I said, in general, the right answer for most people is no, right? And so if they feel like the option to say no is disappearing, then that sort of motivates people to like work a little bit faster. And so I do think that like, if someone does not appear to have a ton of urgency in their fundraising process, then there's no downside as an investor to like waiting to see it develop. Because then you're like, okay, well, maybe I'll get more information, right? Because you're also working in an incomplete information environment. And so the opportunity to get more information is valuable. I don't mind getting updates from founders where they're like, hey, it was great to meet you last week. Since then, I've met with X more people. I've soft circled this amount. I'm driving towards a close date of this. I think that's super helpful to me just to know like where I am in the process. Obviously, don't create fake FOMO, right? Like it should be real, because another thing is that the investor community is really small. And so if you say you have someone and I call them and they're like, yeah, I met with them, but I haven't committed to anything, then that's sort of like an instant ding.
Okay, that's super helpful. And then last question, and you guys, we'll try and get to some of these questions like after the fact and share them with you if I can grab some more of Shiyan's time later. But for now, why don't we talk about, there's another marketplace question, which is what's the most important metric to measure the marketplace potential in your opinion?
The marketplace potential.
Or traction.
I mean, it's transactions, right?
So instead of it being like number of people on one side of the marketplace and number of people on the other side of the marketplace, you want to see how often those people are connecting?
Yeah, it's transactions, right?
Okay. Cool. Well, that was a quick one and that's right on time. You guys, that's actually time for us for this webinar. Thank you so much, Shiyan, for your time today. And to everyone for tuning in. We'll send out a recording. Shiyan, can we send out your slides?
Yeah, totally. Oh, and then I included, I think my partner Elizabeth has this great sort of open source document that's just like questions VCs ask. So you can like dig into that a little bit more. And I think that's like a super useful resource. And we continue to add to that as people, offer up suggestions.
Awesome. We'll share that out with you all as well. Okay, thanks you guys. Have an awesome day.
Awesome. Thanks, guys. Thank you, Kara.
Yeah, you're welcome. Bye.